All right. Well, hello, everyone. It's MJ. I am here today with my dear friend, Ryan Gorman, and he is just a wealth of knowledge when it comes to stocks, bonds, investing, all things money. So I figured he would be a great resource to just to chat with today about the different ways that you can learn to manage your money. Ryan currently lives in Michigan, so he is also suffering through the cold with us. But he is from Wisconsin. I met him years and years and years ago in my hometown. So I'm very excited to have him here with me today and really, really excited to get into the information that he is going to share. So, Ryan, thanks for being here.
Yeah, thanks a lot, MJ. I think this is a cool idea, and financial literacy is definitely probably one of my biggest goals. So I'm really excited to be here.
Awesome. Well, cool. Well, how about you tell everyone kind of your background, what you're up to these days, how you got to where you are, all the good stuff.
Sure. Well, as long as I've known you, I've loved the stock market. My first job while in high school was in banking, and I'd had some internships doing accounting and things like that through college. And it really ultimately managing money and researching stocks was my dream. So I studied finance and economics at UW Milwaukee, got a couple designations, and then moved over to be a partner on a wealth management firm. We do financial planning and things like that, but we manage individual stock portfolios, which is really my favorite part.
That's really cool. So you're one of the people who moved away for a job. What was that process like?
Well, so I originally grew up in Grand Rapids. I moved to in Michigan here. I moved to Wisconsin in high school. My dad went to work for Kohl's, and it's funny because I lived in Manistee, which is where my partner and the firm is, and my fiance was in Grand Rapids. Well, when my dad lived in Grand Rapids, my stepmom is from Manistee, and they did the reverse trip. And it's funny because my dad was in a band with my current business partner, Nick. And so when he would go over to have band practice, I, being like 11 years old, wanting to talk the stock market, would go and talk with Nick. And we've always kept in touch over the years. And so graduating during the Great Recession, there wasn't really a lot of finance jobs. So eventually he's like, I want to, get away from mutual funds, do individual stocks. I need someone else to come on and work with me. You want to move back to Michigan. And having been a Lions fan in Wisconsin for the last 10 years, which is way worse than just about anything else, I decided it was time to move back, and lo and behold, they're still disappointing us.
So you were not the good luck charm, is that what you're telling me?
That's what it seems like for sure.
Well, cool. Well, that's a really awesome story. And it sounds like it's really working out for you. So explain to me, like I'm five, just the difference. These days, everyone's trading and investing and doing all the things financially, but I do think that terminology is important. I do think that the words that we use are important, and there is a distinction. So I will rely on your expertise, and if you could just give us kind of a breakdown of the different terms that you're going to be going over today, that would be super helpful.
Sure. Well, I think, financial markets, you can trade currencies and futures and all those things, and they're quite complicated. But really, for the bulk of people, you have money in a savings account or real estate, something like that. One of the real benefits of the financial market is liquidity. I know you and a couple of our friends are really into real estate, but those aren't really liquid investments. So when you look into things that are traded daily, bonds and stocks are pretty much the majority of that. Bonds are publicly traded loans. So when you own a bond, you're loaning money to the government or to a company, whoever issues them. And then a stock, you're really part owner of a company. So, if there's companies that you do business with all the time, owning a fraction of the company through shares really allows you to be an owner and participate in the growth of the company. And those are really kind of the distinctions. The other thing that I'll mention too is that nowadays a lot of people are actively trading. You hear about it in the news. And so we'll talk, trading is short term in thing to do. A lot of people spend their whole lives trying to learn to trade, and other people think that they're going to show up on day one and be profitable. And so that's a totally different mindset than investing. Warren Buffett is an investor. He says his favorite holding time is forever. Most of us don't have $100 billion to be that luxurious and wait. But investing is truly taking a long-term approach, knowing that owning companies is the only way we can benefit from the long-term innovation of our country, which has a great track record of entrepreneurial spirits, and that's kind of what the stock market does for people.
Yeah, that's awesome. And I really appreciate the distinction because I know it can be a lot to kind of keep track of and to know. So just having that in the back of our minds as we continue the conversation, I think that'll be really helpful. Um,
Hmm.
okay, so I mean, you said that you basically wanted to be in somehow touching the stock market for a long time. What was your initial interest in that?
Well, to me, there's so many puzzles in the economy and the stock market, and it really is, in a sense, a game, a competitive game. And so that's kind of what ultimately drew it to me to it. But then helping people invest, our generation, we don't have pensions and things like that. And so planning for your future is a very important thing. And investing in stocks, one of the books that I would recommend anybody read that wants to learn more about investing is called Stocks for the Long Run by Jeremy Siegel. And it's a bit lengthy, but it really shows you over long periods of time what stocks can do. And so you get this puzzle, and it just so happens that the reward for the puzzle is increased wealth, hopefully over time. And that's what drew me to the profession in general. But learning that most people, their eyes glaze over when you talk about stocks, maybe not so much in the recent weeks, it's kind of exciting now, but talking about economics and earnings and balance sheets is a tough thing, but it's so important. So, I was really excited when I could find a way to take my passion and apply it to people's lives and make it, you know, better. You need to accumulate maybe $1 million in order to live through retirement. If you retire at age 60 and you live to be 90, that's 30 years worth of income you have to plan for. And you can't do that in a savings account, I don't think.
Yeah, not these days. I don't even know. Some days I feel like my savings account is losing me money. I'm like, am I making any money on this?
Certainly, yeah. If the Fed is targeting 2% inflation and they're getting it, let's say, 0.1% is definitely losing you money when you define it as what you can buy with that money.
Yeah, absolutely. No, that's a really good way to look at it. Um, okay, so as far as your career journey and just your investing journey overall, what have been some of your like your big learnings so far?
Yeah, I think that ultimately, when I try to think about how it would benefit the average investor, focusing on the things that you would learn in the Stocks for the Long Run book, just about how even though there's big recessions and big bear markets, stocks still do really well in the long run. I think focusing on that is important, understanding what you're actually trying to achieve. And then surprisingly, what I've learned in the last few years is it's more about your behavior and your mindset than it is about anything else. There's 1.5 million ways to make money in the stock market. There's tons of different types of traders, but you have to find a way that matches your personality, and you have to also react in the right way. One of the designations that I have is about behavioral finance, and you learn about how hardwired our brain is to survive, in the jungle and run. You have a split-second decision to decide: do you hide from the bear or do you run from the bear? And those types of split decisions in the stock market can be totally detrimental. So not only do you learn a lot about yourself and how to apply your goals, but once you understand that in the context of yourself, you can actually understand a great deal about the market, because the market is a wide range of a bunch of people. And, I don't remember exactly who said the quote, but they said some of the smartest people in the world, when thrown into a crowd, become just as manic as anyone else.
Yeah, that is so true. And one of the things, it's kind of been an ongoing theme in financial discussions. I was on a podcast last night and we were talking about real estate, and any sort of investing, we are, we're emotional creatures, we're reactionary creatures. Like, these are things that we have to learn and be able to account for, because we can't be making decisions about money and about real estate and about our finances that are like solely based on emotions. I mean, the occasional emotional purchase, sure, that's going to happen because, well, one, like, treat yourself, but don't treat yourself into bankruptcy. But it's okay to budget for and spend money on yourself, right? Like,
Mhm.
don't go broke doing it, but don't be afraid to make those like more emotional purchases. But when it comes to planning for your future and kind of your long-term goals, I mean, people are really, well, one, and I mean, we've talked about this in the past, but just the lack of financial literacy that's even available. Well, it's available, but you have to look for it, and then wading through all the different options, like that's challenging. It's not something that's taught in school. But also just really understanding how to, like how to react. And I think, and you don't have to touch on this deeply, but I think a good example of this would be what happened with GameStop and the stocks. Like all of a sudden, the internet blows up and everyone's emotionally charged about a situation. So I would love to get any insight that you want to give on that, or just, yeah, any Reddit advice for the Wall Street bettors?
Sure. Well, I'm not overly familiar with the forum side of it, but these short squeezes. So just kind of to talk about a definition, if you think that a stock is going to go down or is overpriced, you can borrow shares from the broker and sell them into the market. So what happens is you have a loan for however many shares you sold short. And your hope is, let's say you sold a stock at $100 and your hope is to buy it back at 80, you profited the $20. So that's a normal part of the market. Short sellers, they tend to be incredibly smart people, but it's a very risky business, because if you own a stock, let's say Enron or one of those companies that went bankrupt, the most you can lose is however much you put into it, which can be substantial. But when you're short a stock, your losses are unlimited, because if the stock presumably goes to $200, you have to buy it back at double what you put into it. And a stock could, in essence, go to infinity. That's never really happened, but your risk is really uncapped. And so, from the best of my understanding, at some point in GameStop, more than 100% of the company shares that existed that are free trading were sold short. And so you had a coordinated short squeeze. Well, as the price goes up and up and up, the brokers or the people that have those loans, they want either collateral or they want to buy the shares back. And so what happens is you create this mad buying, and it becomes a frenzy going up. And it's tough because, those things happen. They don't happen very often. People think that this is the big one, but, in I think it was like 2008, Volkswagen was heavily shorted, and Porsche orchestrated a massive short squeeze on them as well. So it's tough. In any of these environments, it's tough because, like I said, you talk about the psychology of it. I've tried to talk about stocks as little as possible with people, because again, everybody's strategies and their objectives are different. And it becomes hard when you hear about, everybody, this kid that made however many dollars in the GameStop stock that his mom gave him. Like, it just becomes a frenzy, and people, you start to abandon your goals, and everybody just plows in. And yeah, it's definitely been crazy. And I think it's great because so many places now allow you to trade for free, and you can buy fractional shares. So before, back 30 years ago, if somebody was in my business, they would be a broker, right? So they would call somebody with a stock idea. There was no Yahoo Finance or CNBC.com. You couldn't get stock quotes other than maybe in the weekly or evening newspaper. And now you have information available 24/7. There's no commissions. You can buy a fractional. I mean, Google is trading at multiple thousands of shares, or dollars, but you could still buy a portion of it. So a lot of those barriers have come down. But with great knowledge comes great responsibility, and a little bit of discipline. So there's a lot of pros and cons to that. It's way more accessible. Anybody can make money. I'm a firm believer that the market doesn't care what your background is or what your intelligence level is. It's a place that if you go and you do good research and you have good discipline, people can make money in the market. And there's very few places like that, I feel like, in the world. So it's a great place, but it can also be daunting.
Yeah, no, that's really great advice. And it's, yeah, I think the internet age has given us all sorts of things that we're not totally prepared for. But I think there's a lot of truth in that statement. Really, like, anyone has access to it, right? The barrier to entry is very, very low, and the potential is whatever you want to make of it. So I think that's definitely something to keep, because even real estate, right? Like, that's kind of my wheelhouse, but Again, there are a million ways to invest in real estate, and the barrier to entry to buy real estate is fairly high. It costs, a lot of money to do an inspection and to have a down payment. And, if you're going to be doing repairs and like if you're into flipping, I'm not, I just rehab them and then I, buy and hold. Hold forever, right?
Mhm, mhm.
But yeah, I think that's it is a really good tool for people who are just starting out, maybe don't have the thousands of dollars that it takes to get started in real estate, and who have an interest in making a real impact for their future. The market is a really great way to kind of allow people to have that.
Yeah, for
Um,
sure.
okay, so I mean, obviously you've had some good success stories. What are some of the pitfalls that you've faced along the way, or some surprises that may have happened just with investing in the market?
Yeah, so personally, it ultimately boils down to kind of what I was talking about, and that's your own behavior. I mean, anybody even that studies this stuff, you get wrapped up in all the things that we mentioned, the mania and panic and all those types of things. So I think the thing that I would, really the benefit for me has been consistency, right? Warren Buffett, for instance, I love to use him as an example because we all aspire to be him. He doesn't beat the market every year, but he does beat it over time. And a lot of times, when you find a good strategy, like his is value investing, there are periods of time where it doesn't do the best. So really, I think any failure that I'd have would be not sticking to the discipline, not knowing what your goals are, maybe, reacting to a headline and deviating from the plan and the discipline. And I can't stress that enough. Ultimately, it's good to trade and invest and have fun, but when you're going through a financial plan, that kind of is the document. It's just like any business plan or any other objective. Does this action move me towards my goal, yes or no? If it doesn't, probably should rethink about what you're doing. And that's kind of ultimately been it. I feel like anytime that I've had a big blunder, it's getting away from those core values.
Yeah. No, that makes sense. And really kind of having a vision as to where you want to go. As far as, I think I think our for sure our generation is, and I'm sure the younger generation has just been really bad about planning for retirement or even thinking about planning for retirement. It's very much this like live fast, die young, all the things, right? And then all of a sudden, I'm well, like wow, I'm like halfway through my 30s, and I should really be thinking about where I'm going to be in the next 20 to 30 years. So obviously, what's that saying? It's like the best time to start investing was 20 years ago, but the second best time is today. Um,
Mhm.
as you're, as you're working with clients and kind of depending on their goals and their investment level, like what are some basic strategies that you could give to people to just help them get started on their journey?
Yeah, so I think really, whether it's for retirement or otherwise, like you said, get started. The other thing too is, break it down. And, I talk to a lot of people and they're like, well, I don't have a whole lot of money, for instance. That's one thing that usually is a barrier. But it's amazing how much just doing it consistent every month and then letting the market kind of do its thing, that's really the key. The other thing is, so again, starting early, consistency. Don't be afraid to go for advice, because it's so easy and cheap to trade. I think a lot of people do want to do it themselves, and I think having a little bit of money that you can play and speculate, so to speak, is great because you'll learn a lot about the market. You might even make some money, but having somebody help you professionally or develop a plan is also, people are, I think these days, are afraid of paying fees because so much is free. But the value that a good advisor can add over time, I think, really outweigh the cost. So, you don't have to break the bank and stop, going out to eat and stuff all the time. It's like any New Year resolution. Anything that's a huge modification of your life, you're not going to stick to. But if you find that you can save $50 a month or something like that you weren't saving before, and do that consistently, it's really going to add a whole lot of value. The other thing that I see that people do is, if they get enrolled in their 401k or their, retirement plan at work, and they've done a lot of studies from these behavioral scientists that say if you auto enroll, people will do it more so, right? They don't They don't want to go and enroll themselves, but they also won't, if you enroll them, unenroll themselves. So they have all these barriers to get people to invest. One of them are these target date funds, which are nice, right? They automatically build a portfolio for you based on your age, and it gets more conservative or what have you, meaning more into bonds the older you get. And so, people kind of just, they stay status quo. They don't pay attention. So this is always a tough bit of advice because it's, you don't want to check your investments too frequently, but you also don't want to do it too infrequently. So being proactive, starting early, and being consistent, I think is truly the best way for anybody to kind of get on a good plan. In the simple things, keep some money in cash. Don't ever speculate or trade or invest with money that you couldn't afford to lose. You're right. You don't want them to turn the lights off on you. But those are really, I think, the foundations of any good plan.
Yeah, no, that's awesome. Um, so you talked about starting young. Could you talk a little bit just about the power of compound interest and really how, if you do start when you're younger, just the kind of difference that can make in a portfolio?
Yeah, so I think one thing that you and I had discussed before, and maybe some people know about this, is the rule of 72. So if you take the interest rate or the rate of return that you can get on your investments, and you take 72 divided by that number, it's how long it'll take your money to double. And that's not including anything that you would add to it, right? That only adds to it if you're able to put some more money in it and build that up faster. And so I think one of the things that, compound interest is, according to Albert Einstein, the eighth wonder of the world, because eventually the interest that you earns interest. So I recently shared on LinkedIn these 5 questions from FINRA, which is the regulatory body for investors. And they asked this question. They said, if you invested $100 at $2% interest, in 5 years, would you have, more or less than $110? And the answer is more, because the first year you have $100, the next year you have 102. That $2 earns interest, and so it's like a snowball. And so the more and more money you have, the more and more interest that it earns. And that's so important for a couple of reasons. One, getting a positive rate of return is great, but the other thing people don't think about, if you talk about a 30-year retirement or 30 years until you retire, it's inflation. So if you have $100 and you have 3% inflation, in 20 years, you will basically be able to buy whatever $33 could buy today. So not earning 3% just basically takes your money and makes your cost of living leave you behind. So compounding works in 2 fashions. One, to give you a rate of return, but it also is constantly working against you through inflation.
Yeah, I know inflation. I have thoughts about what that's going to look like in the near future. Okay, let me look at my little notes. Okay, so another thing that I kind of wanted to just touch on is multiple streams of income. So obviously, as you're building out your portfolio and just kind of like coming up with a plan and a strategy. Having multiple streams of income is really important. So your wheelhouse is stocks and bonds. Mine's kind of real estate. Most of us are still also working a full-time job. What are some of your favorite streams of additional income?
Sure. Well, I've never gotten into real estate. I'm not very handy. So I find that putting my money in the market kind of gets it to work the best for me. But with anything, diversification is important, right? A lot of the factors that might drive the real estate market don't necessarily apply to the stock market, and vice versa. And so having income coming from a lot of different places means that if any of those valves shut off, you still have income coming in. So I think that that's really, really smart. Now, one thing that I think, just for people that are relying on a stock portfolio, for instance, when you own real estate, you get the price appreciation, but you can't really do anything about that, right? Maybe you could do a line of credit or something like that to tap the equity. That may or may not be a good idea. I don't want to dive too deeply into that, but really your income is whatever positive cash flow you generate, and that's it. Well, when you own a stock, for instance, some of these high growth stocks will pay no dividends, and some of these old have a lot of appreciation of their stock. And so a lot of retirees, for instance, that want income, they'll focus on buying dividend paying stocks. But I always use the analogy of, let's say that you have to live off of the water that you have in your well. So you have this well in the backyard. And let's pretend that price appreciation of your stocks is rain and the dividends are snow. You're not going to go to your well and say, I'm only going to take the snow and drink that. You're going to take water as water. And so, multiple revenue streams coming in from, the stock prices going up, the bond interest or anything like that, it's kind of like a total return portfolio. So again, you always have multiple facets within stocks working for you. But there are periods of time when the stock market goes down. And if you're selling shares to live off of, you might have to sell more shares than you usually do. And that's where it's nice to have, Social Security or perhaps a couple of rental properties. And really, diversification is the key to all of that. And, I don't know that much about real estate, but after watching a couple of these podcasts, then I'll have the ability to try my hand in it as well.
You should look up syndication. It's pretty hands off. You don't need to be very handy to be a part of a syndication. Okay, you did bring up earlier something that's interesting. Just being able to trade like fractional shares, ETFs, things like that. That's like I use Stash to just do some ETF stuff in my free time. But I don't have a ton. I could check, but it's about like $4,000 in that account, and I'm up $700 right now, which is kind of cool. But it's literally I started it several years ago. I've just been throwing money in there. It comes right out of my checking account, each month. So it's nothing like crazy. I'm not going to be living off of it, but it's helped me a lot. Just kind of follow the market in different ways, and I'm like, well, it's a good little rainy day fund if something does happen. But I'd love to just kind of get your input on some of those options.
Yeah, so real quick, we talk about what a stock and a bond is, and they are free trading instruments. Stock prices range from $1 to thousands of dollars. Bond prices tend to be about $1,000 per bond, sometimes 10,000. I'm not really sure of a way to trade fractional bonds, but you mentioned an ETF. So an ETF is an exchange traded fund, and it basically is you're pooling your money together with all the other owners of that fund, and you're either buying a basket of stocks or bonds or something like that. I mean, you can get them for commodities and currencies. And so through that one share, you're able to diversify over hundreds of different securities. And real quick, then I'll talk about what a mutual fund is. So a mutual fund, they price only once a day, but the idea is, again, you're pooling all your money to have it professionally managed. They tend to be a little bit more expensive than an ETF. There are indexed funds, just like there are indexed ETFs. Index, there really is no management. They're very cheap. They just model whatever, the major indexes are that you follow. They tend to have a little bit more cost, but perhaps maybe a little bit of outperformance if you believe that there are good stock pickers out there. So with those being said, I think that those are very cost-effective ways to get the diversification. For instance, you mentioned a $4,000 portfolio. If you find that 20 to 30 stocks is kind of the sweet spot for diversification, if you want to have a mathematical sidebar at some point to talk about where they get that number, but for all intents and purposes, 20 to 30 different stocks is a fairly diversified portfolio. That would be really difficult to do with $4,000. But using these funds that are low cost, you can buy fractional shares. A lot of people that use those types of programs, you can dollar cost average, like I mentioned, $50. Some of them allow you to round up your transactions. So if you spend money at a grocery store, it'll automatically round up and invest for you. So again, I think the power of these types of things are just making it easier. The barriers for people to do this, they go down. And generally speaking, those returns will be whatever the market does, which, according to the book Stocks for the Long Run, tend to be very good in the long run. So I think it's a good way for people to do it, because if you are going to dedicate the time to trade and focus on things, it's pretty time, intensive. I think that a lot of people can do it as a hobby. But I've seen some articles recently that are like, would you, read a book about surgery, go pick up a scalpel and perform, some sort of cardio surgery on somebody? No. And there are people that think that they can do it and be profitable in the stock market. Yes, people can do a really good job, but you got to put the work in. And maybe if you want to just take and benefit from the market, doing a program like you mentioned or something like that that's automated, consistent, and that is probably going to make good returns for somebody in the long run.
Yeah, that's awesome. No, and that's super helpful too. And just knowing that, it is a tool, and those little things like rounding up after you go to the grocery store, or like for me, it just deducted out of my checking account every 2 weeks or whatever. And it's like, it is automatic, but those small things, they start to add up, right? Like all of a sudden I was like, oh, I actually have some money in this account that I could like do something fun with. I could go run away to Mexico for a few weeks or something. But yeah, I think too, and just kind of like exposing people to that sort of stuff. I still think there's a lot of hesitation, because even though it is easily accessible, it's not commonplace necessarily. I think it's definitely becoming more mainstream, and people are really starting to, there's a lot of, between YouTube and Reddit and just the internet in general, just having access to a lot of that information. I think people are maybe less timid than they have been in the past, but I do think there's still just a lot of hesitation about like, well, how do I do this, and how does it work for me, and how do I not lose my tail, and all those things, right? So yeah.
Yeah, and real quick, I mean, one of the things that's so important is talking about risk. I mean, a lot of times, even if you go to advisors or something like that, I feel like a lot of people don't tell you what the risk is.
Sure.
And the risk, I mean, first of all, the market can't give you a loss. I mean, companies go out of business, but the idea with diversification, whether it's real estate or anything else, is that you don't own enough of anything to make a killing in it, but you also don't own enough of anything to be killed by it. And as long as you stay true to those types of things, many of the funds and things that you talked about, and any of them are available. You can go to a Yahoo Finance or something like that, and you can look back and see the worst that it's ever done. And it's fair to assume that it could be worse in the future, but always, I mean, everybody wants to talk about, oh, I just made X percentage in this, and I'm day trading that. But if you think about the worst that you could lose, and you're prepared for that, then you're not going to make any mistakes, hopefully, when that happens, because things go up and things go down. I mean, by definition, we can't make a new high all the time. So you're always going to be a bit of a pullback. So if you assume, you've got $1,000 and the market could potentially lose 30% at some point, like it did last year, that's a $300 loss. Well, if you're expecting that, then it's not as painful, and you're not going to capitulate because, again, you're focusing on your goals. You don't need that money for 5 or 10 years. What it does this year is largely not important to that plan.
Yeah. No, that is a good way to look at it. And you're right. Like, I don't think we talk about risk very well. And obviously everything has risks. I mean, from, the money you invest, to the house you buy, to the job you take, to the person you marry, like there's all sorts of risks in life. And I feel like we are maybe still naive and like fatally optimistic in some of our our ideals about things, but that is an important thing to just kind of recognize, right? I mean, think of, this is before I owned real estate, but back in '06, when housing prices were insane, and all those people who ended up buying houses that ended up being not worth what they thought they were worth, right? Like that's a risk, and that's like a real thing that happened. So I think it's good that you can be upfront and honest about those things. And also having that long term, is it 12? Is like on average about like a 12% return long term in the stock market, give or take.
So if you go back to the book Stocks for the Long Run, that goes from like the 1800s till 2012, and he says over and above inflation, it's roughly 6%. So depending on what inflation is, that's the real return, 6 to 7%. And obviously there are periods of time where it's higher and periods of time where it's lower, and it's hard to focus, like kind of just what you're talking about on, there's risk in anything. And Daniel Kahneman, who's one of the big researchers in behavioral finance, he has this idea called prospect theory, and it's the idea that you feel the pain of like loss and fear twice as intense as you feel elated when you're having a gain. So if you lost way, and that kind of plays into the whole, staying a discipline thing, because I know that you're a Dave Ramsey fan, and Dave Ramsey mentions, growth mutual funds doing 12% a year, but those funds also will, on average, and I'm speaking in generalities here, they'll go down more than the overall market too. So it's a risk return trade-off.
Yeah. Right. Yeah, exactly. Higher risk, higher reward, but people
Right.
focus on the reward part, not the risk part. um, let's see here. Okay, so I have a couple more questions. This has been super helpful, so I really appreciate it. I think just being able to have insight like this and to really just be able to talk openly about money and finances and stocks, bonds, all those things. It's a good conversation to have.
Sure.
Let's see. So we kind of touched on this earlier, but just like any outside of just like getting started, just tips and tricks for for people who are really interested. Should they sit down and talk to someone like you? Should they start reading articles on Yahoo? Like, what's the best way to dive in?
Yeah, I think it really, it depends on knowing what the goals are. Are you going to be trading or are you going to be investing? I'm going to focus more on the investing side of it. I don't want to say that one way is right or one way is wrong, but I think reading that book, Stocks for the Long Run, is good because then you kind of get an idea of all these different concepts. It'll cover different types of analysis. It'll cover the economy, and you can learn if you really want somebody to help you or if you want to do it on your own. It is a long read, so I will say that. And then another great book, it's called The Laws of Wealth, and that's by Dr. Dan Crosby. And it basically is a 10-step program of becoming a good behavioral investor. And I think that that will help anybody, whether they want to do it themselves or not. Another good resource too is Investopedia. That's a great website. They have a lot of good articles that are written. And regardless of what brokerage firm that people use, they probably have some sort of educational experience there. Otherwise, yeah, have a conversation with a financial professional. I mean, if you work for a company that has a 401k or 403b, something like that, there's probably an advisor that you have access to that you could have some of these questions and run off of them. And then the other thing is, the best teacher is experience. So go out and, don't bet the farm on any one idea, but, have a little fun and try to learn with the hands-on way.
That's awesome. Very cool. Are there any other resources you'd like to share, or just words of wisdom to depart with?
Yeah, I think those books, like I mentioned, are a great start. Personally, I try to turn the financial media off. Like ever since last March, when things got a little crazy, I've stopped. So I don't personally find that to be a good resource. I know that's what a lot of people use, and maybe I'll get some flack for saying that, but I definitely don't watch any of that stuff anymore. But yeah, come up with whether you use an online calculator or something, but come up with a plan for saving, and then develop a portfolio or a strategy with an advisor to help you reach those goals. And an advisor might not be able to help you with your real estate and all these types of things, but they can put it all together and say, well, we need this gap to close your funding or something like that. So yeah, I think that's the big thing. Focus on your plan, focus on yourself and your behavior, and don't be afraid to get help.
That is awesome. Yeah, definitely the last one. Don't be afraid to get help. I've had to learn that in real estate for sure, because at some point you're like, I am not the smartest person in the room and I really need someone to tell me what to do. So, well, very cool. I really appreciate it, Ryan. This was really just awesome information, and I think people will get a lot out of listening to this. How can we find you? How can we get connected to you?
Sure. Well, I think the best way is to find me on LinkedIn. That's probably the easiest way to access me. And we put some content and stuff out there from time to time to check out. But yeah, otherwise, this has been great. Like I said, I've always, I mean, I used to joke when we were in school about getting people to invest, and now we're getting to the age where people want to. So this is awesome. I think that it's truly, something that people can learn. It's so vital to the future, and they don't teach, you know, this stuff in school. They don't teach financial literacy really at all, and it's so important. So I'm happy to do it and happy to help any way I can.
Awesome. Well, I definitely appreciate it. And we will talk with you soon.
Awesome. Thanks a lot. We'll talk to you later.
Thanks.